Are money markets and CDs a good investment? With many investors who are tired of the up and down of the stock market, they're looking for a little bit safer waters to put their hard earned money in. But are they as safe as they sound? And are there any downsides to them? Hi, my name's Chris. I'm an advisor with Spark Wealth Advisors, a fee only financial planning firm based in Jacksonville, Florida. Due to the Fed continuing to raise rates in an effort to slow down inflation, rates are a lot higher on money markets and CDs than we've seen in the past few years, which is great for people who utilize those tools. But are there any downsides to keeping your money in those investment types? That really kind of depends on how long you plan on keeping your money in the account or what your goal for that money is. For example, if you're referring to your emergency savings, you're going to need quick access to that money and you really don't want it to be fluctuating that much in price. It's not there really to grow, it's there for emergencies. A money market is a perfect spot for that money. It can quickly be transferred from the money market into your checking account, and it's going to earn a little bit more than your average savings account. What if you only plan on keeping the money invested for 3 to 5 years? Well, then it gets a little dicey. A CD probably would be a good investment option for that money, partially because if you know exactly how long you want to keep it invested, you can look for a CD that matures when you're looking to use the money. Also, that money may not have time to recover as quickly in such a short period of time if the stock market were to be in a down period. However, if you plan to leave the money in the account for longer than 5 years, then a CD may not be your best option. CDs don't carry market risk like the stock market does, but they do carry inflation risk. Basically, the cost of goods and services is going to continue to increase as the stock market increases. And typically there's a correlation between the market and the price of those goods. However, CDs don't typically keep up with that. So I went and I looked for the best rate I could find on a 5-year CD, which was 4.5% today. If you put $100,000 in that CD and you kept it in there at that 4.5% rate over a 5-year period, you would come out with $125,000. Now, if you took that same $100,000 and you put it in the stock market for that 5-year period, looking back from 2018 to 2023, instead of having the $125,000 that you would have had in the CD, you would have come out just over $140,000. And that includes any of the downturns that occurred during 2018 to 2023. So, what if you took those same funds and you took the CD, rates stayed high, and now you take your new $125,000 and you put it and you reinvest it into another 5-year CD? And then we took our stock market money and we just can let it continue to grow. Where would you have turned out? Well, at the end of a 10-year period, the CD would have netted you $156,000. During that same 10-year period, so 2013 to 2023, your money in the stock market would have grown $230,000, even considering the down years. Now, that was using a moderate 60-40 stock to bond portfolio. Nothing crazy. If you have time on your hands, the stock market is always going to beat out CDs, even at the higher rates that we're experiencing now. Let's say you still don't want to invest in the stock market, but you want to find a good CD rate or a good money market rate. I would encourage you to look online at bankrate.com or nerdwallet.com. They're great resources to find high yield savings accounts, CDs, or money markets. And just to name a couple, SoFi Bank, Ally Bank, and Capital One typically have great rates on their products. I would definitely encourage you to stay away from the big box banks, Bank of America, Chase, Truist. They typically pay very low rates. In fact, I looked at one of their accounts this morning, and for a money market with over $100,000 in it, the current rate was 0.01%, which is crazy considering some of the other banks mentioned are offering closer to 4%, if not higher than that. What if you have cash in your brokerage account and you really don't want to invest it into an ETF or mutual fund or stock, but you don't necessarily just want it sitting there not earning anything. There are cash equivalent funds. Let's say you have some cash sitting in your brokerage account and you don't necessarily want to take it out of your brokerage account, but you're not quite ready to put it back into an ETF or buy a stock with it. There are some great money market funds out there that have relatively low expenses and pretty high rates. One of those would be the Vanguard Federal Money Market Fund, which is ticker VMFXX. It's currently paying over 4% and has a relatively low expense ratio. There are a few out there, another Vanguard one, JP Morgan has one, iShares. If you do a quick Google search for money market funds, you should be able to find those. It's a great option if you have money sitting in your brokerage account that's not currently invested and you want to earn a little bit on it. As always, if you found this video helpful, give it a like. And if you have any questions, feel free to reach out to us at Spark Wealth Advisors. Have a great day.